Have the markets bottomed? That is the question I want to figure out, so that's what we will look at today. Even if you're only interested in Bitcoin or a particular altcoin, if we overlay Bitcoin with, for example, Nasdaq, we see that those charts are practically identical. Bitcoin and the whole of crypto simply tails after the larger markets. So the answer to whether Bitcoin has bottomed or not isn't found in the crypto industry. It's found in the global markets, if this market structure continues. In April 2020, when this channel had a few hundred subs, I saw a bottom pattern forming after the COVID crash. We have actually a confirmed bottom pattern on the S&P 500 index, and I bought some stocks then. I doubted it would work out, but it actually did. Back then, that was my most valuable video by far. Now, 2 years later, I'm going to bring up the same template, the same methodology, and see if we can do it again. If the answer to this question, have we bottomed, were obvious, the result would already have been priced in. Remember that when you see someone who is sure about the answer. It's not obvious. The obvious things are already priced in. Instead, I'm going to approach this question differently. But first, I'm very happy to be back in the studio today after 2 weeks of real vacation. I just kicked back and haven't even read emails. I felt I deserved it. First I created tools and processes, and then I used them, and I've played the market really well so far this year. Everyone can handle markets that only go up. But this stretch of the market is tough. Elite performance requires deep recovery. Otherwise, you eventually get fed up. That has been a key element to how I could stay at the top of my game for decades in my previous industry, and I've taken that best practice with me into the blockchain, crypto industry, and investment analysis. Work-life balance is a myth at the highest levels of performance. You have to think in seasons instead. Work hard, focus, immerse yourself in your craft, then you rest deep and fully recover. The best things in life are truly free. That's not a myth. As long as you have food, shelter, and money for medical expenses for your children if they need, more money is not a key element to your happiness. Taking your child to swim in the lake or play with a bucket of water doesn't cost much. Truly, deeply realizing that will make you a better trader or investor, because it will help you to detach from the numbers. If you can manage to just see it as a fun game with no real impact on your happiness, you will be much more successful. See it as breaking the high score in a game. It's fun, you cheer when you succeed and swear when you lose, but it's just a game. Then you switch off the console and go back to your real life, which is the people that you love. So when we now look at the markets, try to detach from your emotions. Let's look at it as a fun game. So the way that we will do this is that we will look back at the previous major crashes in history. Because at the end of the day, markets are about human psychology, and we humans don't change as much as we'd like to think sometimes. So as a guide, we will use the Great Depression in 1929 to 1932. We will look at Black Monday in 1987, the dotcom crash in year 2000 to 2002. We'll look at the mortgage financial crisis in 2007 to 2009, COVID-19 in 2020, and then we will see where we are today, in the current crash that I've called the hangover recession. So to explain this methodology, in the Great Depression in 1920s, markets fell 89.53% from the peak to the bottom. Rounded, that is minus 90%. The number of weeks from the peak to the bottom was 148 or 149 bars, which is equivalent to weeks, because I've set this to weekly time frames. So 148. Then, after the bottom, there was a recognizable bottom pattern in the chart. See this level here, which broke down, turned into resistance, and we had a smaller dip, we broke up, and then that level that was previously resistance turned into support once and twice, 3-4 times, and then up we went again. So this could be seen as an Adam and Eve pattern if it had been a little lower, or it looks a little bit like a cup and handle pattern. We can argue about that, but it's definitely a bottom formation with a horizontal neckline that turned into support. A clear and easy to trade pattern under classical charting. So if we had been there, we would have been able to get in, not here, because it was impossible to say that this is the bottom when it's the bottom. So we couldn't get in at 40, but we could have gotten in at 80. And it didn't take so long until that turned out to be a really great entry. That's what I tried to capture here. There was a bottom chart pattern, cup and handle or Adam and Eve. It was also possible to detect that the trend had changed. If we put Larsen line on 2-day candles, you see that spared you the entire decline and then gave you confidence to enter at this chart construction, because that also coincided with the trend reversal. That hadn't happened since the beginning of the crash. So the optimal time frame for Larsen line in 1929 would have been 2-day candles. And again, this is not a process to catch the bottom. There is no process in the world that lets you do that with consistency. We're trying to catch a midsection of the move with higher confidence. And in this case, from the bottom until we repurchased was something like 295 days. That's this one, bottom to repurchase, calendar days 295. Then we scrolled forward here to the next major event, which was the Black Monday in 1987. Here, from the peak to the bottom was minus 41%. But it was much faster. The duration from the peak to the bottom was only 8 weeks. But here comes something interesting. After the bottom had consolidated, it formed a recognizable chart pattern under classical charting, an ascending triangle, which broke out, and again, if we had Larsen line on 2-day candles, that coincided very well with a recognizable trend reversal, giving a confident entry. Not at the bottom, because I argue that knife catching is just luck when it works, but it would have enabled us to get in on a great entry and ride the midsection of the trend up. Entry at 2000, which soon became 10,000. So we had a recognizable chart pattern, and the duration from the bottom until what I argue was the optimal risk-reward entry was 270 days. Quite similar to the Great Depression. Now let's look at the next catastrophe, which was the dotcom crash. While this was even worse on Nasdaq, now we're on Dow Jones, and here from peak to bottom the drop was minus 39% that we have recorded here. The duration was much longer, it was 143 weeks. But also here, after it had bottomed, the chart formed a recognizable chart bottom pattern. In this case, it was an inverse head and shoulders, shoulder, head, shoulder. It broke through the neckline, and the optimal time frame here was a little bit longer. It was a 1-week candles that would give us an entry that coincided with the chart, high confidence entry, and that entry at 9,000 then became 14,000, and then the next major disaster soon followed. And the time from the bottom until the repurchase was again quite similar. It was 284 days, very similar to the Great Depression and Black Monday. But then time frames changed. Now we're at the mortgage financial crisis that most of us lived through and maybe have in fresher memory. Here, the drop from the peak to the bottom was minus 54%. The duration in weeks was 73 weeks. And again, there was a recognizable bottom pattern in the chart. And again, it was an inverse head and shoulders. Shoulder, head, shoulder. Here's the neckline. And here we could trim down the time frames without getting any fake flips and have support from the trend reversal coinciding with the bottom pattern in the chart. So the time from the bottom until where I argue the optimal repurchase point was only maybe 60 or 70 days. I put 64 days here. Now we're coming to very recent events. The COVID crash of year 2000. There the decline was actually less. It was less than I expected. From peak to bottom was only 38.5%. And the duration in weeks from the peak to the bottom was only 6 weeks. But look here, again, there was a bottom pattern, as I highlighted in that video when it was actually happening. On Dow Jones, it looks clearer like a cup and handle. And maybe because the world is accelerating, we could step down to even shorter time frames, even down to 12 hours, catch a great entry, and still get out pretty close to the market top in 2022 this year, without any fake flips in between. So I put 12 hours here, and from bottom to the optimal repurchase date, I put 78 hours. So now we have statistics from 1, 2, 3, 4, 5 previous major market disasters. And then we will use the learnings from that and apply it on the current situation. What many people are doing on crypto Twitter right now is that they are taking the price action of Bitcoin's history and applying it on the current situation. And I think they fail to understand that Bitcoin has only lived through this stretch here, from say 2008, 2009 until today's date. But if you look here at Dow Jones, this stretch of the market doesn't look anything like the stretch before, the 10 or so years before that. You can see it so clearly. So I'm not sure that extrapolating this part of the market on today is even correct. Maybe we will get something like this instead. I don't want to name anyone specifically, but those who have created those models, maybe they are too young to even remember, or it feels like that's something that happened only to their parents. There's no way that's going to happen in the markets today, but I think it could. It's at least possible. The history doesn't predict the future, but quite often it rhymes. So where are we today? If we do the same thing, at the current situation, we measure from the peak to our current bottom, we get that the decline has been minus 19.75%. So this number here is below 20%. And if we then look at the previous 5 crashes, 19.8% isn't much. Actually, the duration in weeks from this peak to this bottom, if it was the bottom, was 23 weeks. And the maybe most interesting finding so far is this box. Where is the bottom pattern? And at least I can't see any on any time frame. That has confirmed as I'm recording this video. So I've written none yet. Now this was Dow Jones, but what about S&P 500? Fear not, I've done that one too. I've done the same exercise on S&P 500, starting from the Black Monday in the 1980s, the dotcom crash, financial crisis, the COVID dip, and the current situation. On S&P 500, the decline on the Black Monday was minus 41%, dotcom crash was minus 50%, mortgage crisis minus 58%, the COVID crash was minus 35%. The duration varied greatly through these ones. That's what surprised me the most during the COVID situation. But look here, once again, in all those situations, there was a recognizable bottom pattern in the chart. Another thing that's interesting to note is that this accelerated the optimal time frame to catch this. As I said in that video 2 years ago, during the COVID crash, you could even set this down to 4 hours. And then you have to be on the futures chart, so you get the reading 24 hours. Then that time frame legit avoided the entire crash, did not give any fake signals, and gave increased confidence to enter when the bottom pattern confirmed. Then you could move up stop loss and play this more as normal. And only now the daily time frame has turned down again. And the time frame from the bottom to the optimal repurchase date in calendar days, where I argue was the optimal risk reward. If you look back in retrospective, where was the optimal risk reward to enter? And I say it was after this many days. And here you can see that that time frame reduced drastically from the 80s to 2000s to the financial crisis and the COVID dip. So where are we then today on S&P 500? The drop from the peak to the latest bottom was minus 24.4%. Minus 24%. The duration from here to here was 23 weeks. And where is the bottom pattern? I can't find it. There is no bottom pattern confirmed here. And what is the optimal time frame to track the trend? Is it 4 hours? No, unfortunately not. If we go to the futures and we switch to the 4-hour time frames, this has provided a lot of fakes here. where we thought the trend has turned, but in fact it hasn't. So clearly this is not the situation here. Pretty much the same thing on the 12-hour. It's only when we go to the daily candles that we see a solid trend that really captured the true underlying trend, and that one has not reversed yet. So the 1-day candle trend is still down. So far 45 days have passed from the latest bottom until today. So if we look at the history, unfortunately, this huge decline that we have seen is not consistent with the magnitude of the decline in the previous major crashes. And the fact that there is no confirmed bottom chart pattern worries me quite a bit. Remember, like I said, if this was obvious, it would already be priced in. And the conclusion of all the world's macro analysts, what about inflation, what about recessions, all of those conclusions are consolidated into the price. And if they all agreed that this bottom is in, this is going to turn up, there would form some kind of revealing bottom pattern in the chart that gives us clues that people are buying, they're trying to accumulate as much as possible at as low prices as possible. And we're not seeing that yet, unfortunately. So as much as I would love to go all in on my favorite assets like Bitcoin, all these statistics worry me quite a bit. So what to do then? How to buy the bottom? Now I'll repeat some slides that I used 2 years ago. I'd say there are 3 approaches that I use. Number 1, you buy when there's blood in the street, even if the blood is your own. I've talked about that one many times. The second one is that you do a gamble entry. You buy and you set a stop loss, and maybe you get lucky, maybe you get in. If we switch Bitcoin to 12 hours, the trend is about to turn up. If we get 1 or 2 more updates, it will probably turn yellow here. So you take a gamble and buy, and if it falls back below support into the range again, you cut the position and try again. And if you're right, the stop loss will never hit. It doesn't cost you anything. But I said 3 approaches. So what's the third one? How to buy the bottom. Don't. So that's really my strategy. I will just wait here a little bit, see if the situation clears up. There isn't a bottom pattern yet. There isn't a trend change on the time frame that has worked, even though we have retraced almost half the drop. So unlike that time 2 years ago, I'm not buying any stocks or crypto today. It could be the bottom, but I feel that it's still not optimal risk reward. So I detach from this, I park my own FOMO and wait for a clearer confirmation, which might well come should this neckline break, which if we instead look at the Nasdaq index, it already has, by a little bit. Then things already look more positive. If we break up through a key resistance and turn it into support, then at least we have that, and maybe Larsen line turns up soon on a reliable time frame. As always, don't fall for the scammers. You can only get Larsen line on www.ctolarsen.com. Everything else is a scam. Make sure you subscribe, because I will keep you guys updated. Like the video. I'm back. Thank you, tack. CTO Larsen out. Hej då!